Welcome back to the deep dive. Today we're diving into a topic that, well, at first glance can feel like you're navigating a pretty dense financial jungle.
Definitely.
The capital asset pricing model, or CAPM. But our mission, like always, is to give you a shortcut, to really being well-informed on something that fundamentally reshaped how we understand risk and return in finance.
It really did.
We've pulled from a fantastic series of articles that properly dissect its theory, its strengths, and its weaknesses too. So, okay, let's unpack this. What exactly is CAPM and why is it still such a cornerstone?
Oh, it's absolutely foundational. I mean, some people would argue that financial management only truly became a distinct academic discipline when William Sharpe published his derivation of the CAPM back in 1964.
Wow, 1964.
Yeah, it was a really pivotal moment.
Yeah.
So for this deep dive, we'll explore the model's theoretical underpinnings, its real-world uses, and its inherent limitations as well.
Okay, so when people talk about CAPM, they always mention this linear relationship. Can you break down for us, just at its most fundamental level, what that relationship is and why it's so important in finance?
Sure. So at its core, the CAPM formula represents a direct linear connection between the required return and investor demands on an investment, and that could be anything, a stock, an entire business project, and its systematic risk.
Systematic risk, okay.
Yeah, if you've ever looked at a finance formula sheet, you've probably seen it there. The core insight of CAPM, and this was revolutionary, is that it's the first widely accepted model that actually tries to put a price tag on that unavoidable market risk.
Price tag on risk.
Exactly.
Yeah.
It tries to quantify precisely how much return investors demand for taking on that specific systematic exposure.
So it's about figuring out how much extra return you should get for taking on general market risk. And what's fascinating, as you said, is that the model focuses only on systematic risk. Can you quickly clarify what that is again and why it's so critical?
Right. So systematic risk, sometimes called market risk, it's that broad, unavoidable risk, the kind you can't just get rid of by diversifying your portfolio.
Like big economic downturns or something?
Exactly. Think of the broad movements of the entire market. CAPM says investors are only compensated for taking on this kind of risk. Why? Because any unsystematic or specific risk, the risk unique to one particular company or asset that can, in theory, just be diversified away if you hold a broad enough portfolio.
Okay, that makes sense. But now, here's where it gets really interesting and, where a lot of the criticism tends to pile on CAPM, its underlying assumptions.
Yes, the assumptions.
Many people argue they're just unrealistic, right? Like creating this gap between the neat theory and the, let's face it, messy reality of finance. How big is that gap, really?
That's the million-dollar question, isn't it? Let's walk through those assumptions and then, immediately look at their real-world side. First, the model assumes investors hold diversified portfolios. This means, like we just said, investors only need a return for systematic risk because the other kind, unsystematic, has been diversified away. Now, from a real-world perspective, this actually seems, quite reasonable.
Really?
Yeah. I mean, investors can easily and pretty cheaply diversify nowadays to essentially track the stock market. They can build portfolios that largely mirror what the overall market is doing.
So hang on, if I'm just a small investor and maybe I don't have a perfectly diversified portfolio, does that mean CAPM isn't really relevant to my decisions? Or is it more about how the market overall behaves?
That's a great point.
Yeah.
It's definitely more about how the market as a whole seems to price assets and compensate investors in general.
Yeah.
For an individual who isn't fully diversified, that specific risk still absolutely matters to them.
Okay.
But for the general functioning of efficient markets, the model's focus on systematic risk for pricing assets actually hold up surprisingly well, mainly because there are enough large, diversified players influencing prices.
Right, the big institutional investors.
Exactly. Next assumption. The single period transaction horizon. CPM assumes a standard holding period, usually 1 year, just to make returns on different things comparable.
Like comparing apples to apples.
Precisely. And again, in the real world, this assumption also seems pretty reasonable. Even if you hold stocks for decades, returns are almost always quoted annually, right? So it gives us a consistent benchmark.
Okay, 2 down. Seems okay so far.
Well, then we get to the assumption that investors can borrow and lend at the risk-free rate of return. Now, this is crucial in the theory.
Why is that?
Because it provides a sort of minimum required return for any investment, and it corresponds to where the security market line, the SML, that's the graph showing expected return versus systematic risk, hits the axis.
Okay.
This one, however, is a more serious problem in practice.
Ah, I knew there'd be a catch.
Yeah. Individuals, like you or me, we can't actually borrow money at the same rate as the government.
No kidding.
The risk associated with us is just much higher. So trying to borrow at the rate the government pays on its short-term debt, not realistic.
Right. So if I walk into a bank and ask for the treasury bill rate on a loan, they'd probably show me the door. It really shows that gap between theory and reality.
Exactly. And this inability to borrow at the true risk-free rate, it means that in reality, the slope of the SML, that line, is probably a bit shallower, a bit flatter than the pure theory predicts.
Less steep. Okay.
Then finally, we have the assumption of a perfect capital market. This is a big one. A whole bundle of assumptions, really.
Sounds complicated.
It basically means all securities are valued correctly, their returns plot perfectly on the SML, and a perfect market implies, well, no taxes, no transaction costs, free and perfect information available to everyone instantly.
Wow.
Identical expectations among all investors. Everyone is rational, risk-averse, trying to maximize their utility, and there are tons of buyers and sellers, so no one person can influence prices.
So basically a world where everyone knows everything all the time for free and acts perfectly rationally. That sounds like a finance textbook dream, or maybe a nightmare for anyone trying to find an edge.
Exactly. Now, obviously, real-world capital markets are clearly not perfect like that. But you could argue that well-developed stock markets like London or New York do actually show a pretty high degree of efficiency in practice. Information gets priced in quickly most of the time. However, there's definitely still scope for securities to be priced incorrectly sometimes, and therefore not plot neatly on that theoretical SML.
Okay, so even with that whole laundry list of ideal conditions that don't quite match up, you're saying the core idea, that linear relationship, still kind of holds up in the real world. What gives you confidence it isn't just, totally off base?
That's a fair question. And look, while CAPM's assumptions definitely paint an idealized world, one that doesn't perfectly mirror reality, decades of research keep suggesting there's still a strong possibility, even likely in the real world, of a generally linear relationship between the return you require and the systematic risk you take on. It captures a fundamental truth, even if the edges are blurry.
Okay, so let's bridge that theory-practice gap a bit more. What does all this mean for making actual investment choices? How does CPM stack up against something, say, like the weighted average cost of capital or WACC? That's the company's overall blended cost of finance, right?
Right. WACC can be used as a discount rate for evaluating new projects, and this is a big but, only under some pretty restrictive assumptions.
Such as?
Well, for instance, the project usually needs to be small relative to the whole company. Its business activities need to be very similar to what the company already does. The way it's financed, the mix of debt and equity has to be similar too. And crucially, the existing lenders and shareholders can't suddenly demand higher returns just because of this new project.
So basically, WACC only really works if the new project doesn't significantly change the company's overall business risk or its financial risk profile.
Exactly, you've nailed it.
So just to be crystal clear, if the project's risk is different, maybe it's a completely new venture or much riskier than the core business, is that where CAPM really comes into its own as the tool for figuring out a project-specific discount rate?
Precisely. Here's the critical takeaway, really, for making smarter investment decisions. WACC is kind of a blunt instrument.
Okay.
CPM, when used for project appraisal, is more like a scalpel. If your project's risk level is different from your company's average, just slapping the WACC on it can lead to some really bad choices.
Like what?
Like rejecting good projects that actually would add value, or maybe worse, accepting bad ones that will destroy value. CPM helps you avoid that trap. The benefit of using a CPM-derived project-specific discount rate is significant. It simply leads to better investment decisions.
Can you give an example?
Sure. Let's imagine a project A. If you just use your company's WACC as the hurdle rate, you might reject it because its expected return, its internal rate of return, or IRR, is slightly less than the WACC.
So, looks bad on the surface.
Right. But maybe project A is actually less risky than the company's average operations. If you calculate a specific discount rate for it using TPM, you might find its required return is much lower. So its IRR might actually be comfortably above the SML for its level of risk.
Meaning
it offers more than enough return to compensate for its systematic risk. Accepting it would actually increase shareholder wealth. WACC would have told you to ditch it.
Okay, I see. And the other way around.
Yeah. Conversely, think about Project B. Maybe if IRR looks great, it's higher than the company's WACC. So using WACC, you'd say go for it.
Seems like a winner.
But what if Project B is actually much riskier than the company's normal business? If you apply a CAPM-derived rate reflecting that higher systematic risk, you might find its IRR actually falls below the SML.
So it doesn't offer enough return for the risk involved?
Exactly. Insufficient compensation for its systematic risk. CAPM would tell you to reject it. This really raises an important question, doesn't it? Are companies routinely missing out on valuable projects? Or worse, taking on value-destroying ones just because they're using the wrong, simpler discount rate like WACC?
It definitely paints a stark picture of how using WACC blindly can mislead you. But I mean, are there ever situations where WACC is the right call or at least good enough despite these limitations?
Oh, absolutely. If a project genuinely is small and it really doesn't change the company's overall business or financial risk profile in any meaningful way, then sure, WACC can be a perfectly adequate and frankly simpler discount rate to use.
So it's not always wrong.
Not always. The key is just understanding when those restrictive assumptions actually hold true for the specific project you're looking at.
That makes a lot of sense. Okay, so despite these theoretical debates and the real-world complexities we've talked about, why has CAPM remained so popular? I mean, for over 40 years now. What are its enduring advantages that keep people coming back to it?
Yeah, it's got remarkable staying power. Its popularity really stems from several core advantages. Firstly, as we've discussed, it considers only systematic risk.
Right.
And that aligns pretty well with the reality that many, especially large investors, hold diversified portfolios where that unsystematic risk has effectively been canceled out.
Okay, that's one.
Secondly, it's not just some idea someone cooked up. It's a theoretically derived relationship between required return and systematic risk. And it's been subjected to, well, tons of empirical research and testing over the decades.
So it's been kicked around and studied a lot.
A lot. Thirdly, it's generally seen as a much better way to calculate the cost of equity that the return shareholders require than some older methods, like, say, the dividend growth model.
Why better?
Because CAPM explicitly considers a company's specific level of systematic risk. Its beta, its sensitivity to market movements relative to the stock market as a whole. The dividend growth model doesn't really capture that risk element directly. And finally, as we just spent some time on, it is clearly superior to just using the WACC for providing those project-specific discount rates when the project's risk profile is different from the company's average.
That's a pretty compelling list of strengths. But, for a balanced discussion, we absolutely have to dig into the disadvantages too, the real-world hurdles you face when you actually try to use it.
Indeed. And there are definitely practical challenges. One of the main ones is just assigning reliable values to the CAPM variables themselves. The risk-free rate, the equity risk premium, and the equity beta.
Okay, let's take them one by one. The risk-free rate.
Well, we usually use the yield on short-term government debt as a proxy for the risk-free rate. But that yield isn't fixed, is it? It changes sometimes daily, depending on economic conditions, central bank policy.
Right, it fluctuates.
So often people use a short-term average to try and smooth out that volatility, but it's still an estimate. It's not perfect.
Okay, what about the equity risk premium, the ERP, that extra return for market risk?
The ERP. That's even trickier to pin down. I mean, a stock market can actually provide a negative return in the short term if share prices fall more than dividends pay out.
Yeah, definitely seen that happen.
So it's usual practice to use a long-term historical average ERP, but research shows the ERP itself isn't stable over time. It changes based on investor sentiment, perceived economic risk. For example, in the UK right now, an ERP value somewhere between, say, 3.5% and 4.8% might be seen as reasonable.
That's quite a range, though.
It is. And that uncertainty in the ERP value, well, obviously it introduces uncertainty into the final required return you calculate using CAPM.
And beta, the risk measure.
Similar issue. Beta values, which measure how sensitive a specific stock is to overall market swings.
Yeah.
You can find them published regularly for listed companies, but they aren't constant either.
They change, too.
Oh, yeah. A company's business mix changes, its debt levels change, the market's perception of its industry changes.
Yeah.
All that affects its beta. So using a historical beta assumes it will hold true for the future, which adds another layer of, uncertainty to the calculation.
So just getting the right numbers into the formula can be a bit of a headache. Okay, let's dive into another major challenge area. Using CAPM specifically for investment appraisal for deciding on projects. Where do things get complicated there?
Right. This is where it can get quite complex in practice. Definitely requires some careful work. One really common difficulty is finding suitable proxy betas.
Proxy betas, what are those?
Well, if your company is considering investing in a new business area where it doesn't currently operate, you need to estimate the beta, the systematic risk, for that specific type of business. You can't use your company's overall beta.
Okay.
So you look for other publicly listed companies, proxy companies, that are already primarily in that line of business. The problem is these proxy companies rarely do only one thing. They often have multiple divisions, multiple business activities.
So their overall beta reflects a mix of risks.
Exactly. So you have to try and somehow disentangle the beta for just the business activity you're interested in from the proxy company's overall reported equity beta. You essentially have to treat the proxy's equity beta as a weighted average, like a portfolio beta of its different parts.
Okay, that sounds fiddly.
It can be. Let's take a quick example. Say this company, GIPCO. Imagine its overall equity beta is 1.2. But you know that maybe 75% of its business is in the area you want to invest in. Let's call that beta 1. And the other 25% is in some totally unrelated area, which you estimate is, say, 50% riskier than beta 1.
Okay, following so far.
So you'd have to set up an equation, basically. The overall beta 1.2 equals the weighted average of the parts.
Mm-hmm.
So 1.2 equals 1.75 times beta 1 plus 0.25 times 1.5 times beta 1. Solve that.
Calculating.
And you'd find that the proxy beta you actually want for your project, beta 1, comes out to about 1.067.
Wow. Okay. So you have to do some algebra just to estimate the input risk measure.
Precisely. And the real challenge there, as you can probably guess, is actually getting reliable data on the relative market values or sizes of a proxy company's different business segments. That information isn't always easy to find.
I can imagine. What else makes project appraisal tricky?
Well, related to that is the process of ungearing the proxy company betas.
Ungearing.
Yeah. Remember, a company's equity beta reflects both its business risk, the risk of its operations, and its financial risk, the risk from its debt levels. For project appraisal, you usually want to isolate just the business risk first. So you have to take the proxy company's equity beta and mathematically remove the effect of its specific debt level to get an asset beta or ungeared beta.
And then presumably re-gear it for your own project's financing.
Exactly. But doing that ungearing step accurately requires detailed information about the proxy company's capital structure, its mix of debt and equity, the market values of that debt, which, again, may not be readily available or easy to estimate, especially if they have complex debt, untraded debt, convertible bonds, things like that.
More data headaches.
Yep. And even the simplifying assumption people often make that the beta of debt is 0, meaning debt is risk-free while common, it's not strictly true. Government debt might be close, but company debt always has some risk. So assuming 0 beta introduces a small inaccuracy into the final discount rate.
Okay.
And one last point on project appraisal. That single period assumption we talked about earlier. CAPM assumes the risk-free rate, the ERP, the beta are all constant for one period. But most investment appraisals look out over multiple years, multiple periods.
Right, you discount cash flows way into the future.
Exactly. So using CAPM typically involves assuming those variables stay constant over the entire life of the project. But, well, our real-world experience tells us that's just not true. Rates change, risk perceptions change, betas change.
So it's another layer of approximation.
It is. It adds complexity and potential inaccuracy to multi-period appraisals.
Wow. What a journey. We've really navigated the capital asset pricing model from, its theoretical roots all the way through its real-world uses and quite a few limitations and challenges. So what does this all mean for you, the listener, as you try to make sense of things in this information-rich world? It really seems that despite all the criticisms, all the practical headaches in applying it, CAPM is still a heavily researched and crucially widely used model in finance.
Precisely. While the attacks against it, the academic debates have certainly maybe increased in recent years, lots of research has actually shown that the CAPM stands up surprisingly well to a lot of that criticism, especially in practical terms. And, well, until something genuinely better, more robust, and still usable comes along.
Which hasn't really happened yet.
Not in a way that's displaced CAPM entirely. So until then, the CAPM remains a really, really useful item in the financial management toolkit. Flawed, yes, but useful.
So here's something to think about as you go about your day. How is it that these foundational theoretical models like CAPM, even with all their acknowledged imperfections, their gaps compared to messy reality, how do they continue to shape decisions in really vital fields like finance? What does that tell us about the enduring power, maybe, of elegant simplicity, even when it's up against a complex world?